Ever feel like some unseen puppet master is, pulling the strings on market
Yeah,
prices?
making your favorite snack suddenly costs more, or maybe a new product just explodes overnight while others vanish.
Exactly. Today, we're pulling back the curtain on those subtle, powerful forces that shape, well, everything. From your morning coffee price to your biggest investments. This deep dive is your shortcut to understanding the invisible hand of market influences on business.
Mm-hmm.
We've distilled a ton of info to give you those aha moments, but without the, information overload.
And our mission is really to demystify how businesses navigate the constant ebb and flow of the market. We're going to unpack core concepts like demand and supply.
The big ones.
Yeah, find out where markets naturally settle. Explore crucial strategies companies use to win. It's all about connecting the dots so you truly understand the economic world around you.
All right, let's unpack this. We hear supply and demand tossed around all the time, right?
All the time.
But what do these terms really mean in practice, especially for you, the consumer? Let's start with demand.
Okay. When we talk about a demand curve, think of it as like a visual blueprint. It maps out the absolute maximum quantity of a specific good that consumers are willing and able to purchase at every single possible price.
So it's the whole range of possibilities.
Exactly. It's a snapshot of potential buying. Now, zoom in a bit. Quantity demanded. That's different. That's
Yeah.
the specific amount people want to buy at one given price point.
Got it. 1 point on the curve.
Precisely. So the demand curve is the whole picture. Quantity demanded is just one dot on that line. And here's a really crucial distinction.
Okay.
If the price itself changes, that's just a change in quantity demanded. You're simply moving along the existing demand curve, kind of sliding up or down that same line.
But what's really fascinating is when the entire demand curve shifts. That's a change in demand.
The whole line moves.
The whole line moves left or right. And this happens due to anything other than a change in the price of the good itself. It's like the fundamental rules of the game have changed.
And the fundamental law of demand tells us something pretty intuitive. Price and quantity demanded are almost always inversely related.
Meaning,
When the price goes up, people typically want to buy less, and vice versa. It makes sense, right?
it does, but why? Why does that natural inverse relationship happen?
Well, there are two really powerful forces at play here. First, there's the substitution effect.
Okay.
Think about it. If the price of Pepsi drops, what might you naturally do?
Maybe buy Pepsi instead of Coke?
Exactly.
Yeah.
You substitute it because it's now relatively cheaper. That's the substitution effect.
Simple enough. What's the other one?
The second is the income effect. When prices fall, your existing money effectively buys more.
So your purchasing power goes up.
Precisely. Your purchasing power or real income increases, even if your actual paycheck hasn't changed. This means you can afford more of, well, everything, including that good that just got cheaper.
Wow, okay. So it's not just the price itself that's causing these massive shifts in the whole curve. It's everything around the product. That's genuinely fascinating.
Absolutely.
What are some of those hidden movers then? The things that make the entire demand curve just jump?
Right, so beyond price, several factors can independently shift demand. Think about changes in wealth.
Like winning the lottery.
Yeah.
Or maybe just the stock market doing well.
Exactly. If people suddenly feel wealthier, maybe their investments are booming, demand for luxury items, high-end sports cars could surge. The whole curve for those cars would shift right and increase in demand.
Okay. And what about how other products fit into the picture? Does the price of butter affect margarine demand?
It sure does. That's where changes in the price of related goods come in. If we're talking about substitutes, like your coffee and tea example,
Right.
if the price of coffee suddenly jumps, what happens? People might think, tea looks like a better deal now. So demand for tea shifts, right? It's now more attractive.
Makes sense. What are the things that go together, like printers and ink?
Good example. Those are complements, like personal computers and monitors. If the price of computers drops significantly, demand for monitors and printers, which are used with computers, will likely increase. The demand curve for monitors shifts right. They're tied together.
So it's like a ripple effect across different products.
Yeah,
What about changes in our own pockets?
Yeah.
Does getting a raise change things?
definitely. Changes in consumer income are a huge factor. Generally, if incomes rise, demand for most goods shifts right. Think about retail workers during the Christmas season.
Yeah, they get bonuses.
Right, and their bonuses mean more spending power, so demand for all sorts of goods increases. Also, simple changes in consumer tastes or preferences are powerful.
Like fashion trends.
Exactly. Remember when bell-bottom jeans made a comeback? That's a shift in taste-driving demand, pure preference.
Okay, what else?
Well, our expectations matter too. If you expect bus pass prices to rise next month,
You'd probably buy your pass now, right?
you got it. You might buy more now, shifting current demand to the right. And lastly, simply having more buyers in a market. Think about an aging population increasing demand for prescription drugs. More people needing something means the entire demand curve shifts right.
Okay, that covers the demand side really well. Let's flip the coin. What about supply?
Right, supply. Just as there's a law for demand, there's a fundamental law of supply. And this one's a bit different. Price and quantity supplied are usually positively related.
So higher prices mean more supply.
Generally, yes. Because higher prices usually mean sellers are willing and able to produce more, there's potentially more profit to be made. So when we define supply, the supply curve illustrates the maximum quantity sellers are willing and able to produce at each and every price.
And quantity supplied, is that like quantity demanded?
Very similar concept. Quantity supplied is just the specific amount producers are willing and able to produce at a given price. 1 point on the supply curve.
I see. So similar to demand, there's a key distinction between moving along the supply curve and the entire curve shifting.
Precisely the same logic applies. A change in quantity supplied is a movement along the existing supply curve, and that's caused only by a change in the goods' own price.
Okay.
But a change in supply means the whole supply curve shifts, moving left or right, and this happens due to anything other than a change in the price of the good itself.
Got it. So what makes producers suddenly decide to, churn out more or maybe hold back, aside from the selling price they'll get? Is it like they're looking into a crystal ball?
Well, maybe not a crystal ball, but their expectations are huge. Let's say Coffee Products Inc. suddenly expects future coffee prices to drop.
Oh.
They're not going to just sit on their beans, right?
Right.
They'll likely increase their supply now to maximize current profits before the price falls. That shifts the supply curve right, an increase in supply today.
Ah, clever. What else? Costs must play a role.
Oh, absolutely. Changes in production costs or the price of inputs are massive. If wages for coffee pickers fall, for instance, that lowers production costs. It becomes cheaper to produce coffee.
So they'll supply more.
They'll supply more at every price level. The supply curve shifts right, an increase in supply.
That makes perfect sense. What else influences how much a company is willing to put out there?
Consider changes in the price or demand for other goods that a firm produces. Let's say a company makes both butter and margarine,
Okay.
and demand for butter suddenly plummets. They might shift resources, cows, machines, whatever, over to producing more margarine, increasing the supply of margarine. The supply curve for margarine shifts right.
Interesting. So they can pivot based on other products.
Yep. And then there's the government's role. Changes in subsidies or taxes. A new tax on cigarettes will increase the cost of production.
Leading to a decrease in supply. Curve shifts left.
You got it. Conversely, a government subsidy, basically money given to producers, will lower their costs and increase supply, shifting the curve right.
And technology. That must be huge.
Absolutely. Changes in production technology are often game changers. If a company introduces some new tech that dramatically increases, say, bottle output for a beverage company.
They can make more faster and maybe cheaper.
Exactly. They can now supply far more efficiently, shifting the supply curve right. More supply at every price.
It's incredible to see all these individual pieces, demand factors, supply factors, but what happens when these invisible forces finally collide in the marketplace?
That's where they find their natural balance point. We call this market equilibrium.
The sweet spot.
Kinda, yeah. It's the magical point where the supply and demand curves intersect. At this price, often called the market clearing price, the quantity supplied perfectly matches the quantity demanded.
So everyone's happy, buyers find what they want, sellers sell what they made.
In theory, yes. There's no pressure for prices to change because the market has cleared. Everyone who wants to buy at that price can, and everyone who wants to sell at that price can.
But what happens when the market isn't at this sweet spot? What if the price is off?
Good question. If the price is set below equilibrium, think about it. Low price means lots of people want to buy.
High demand.
But suppliers aren't so keen to sell at that low price.
Low supply.
Right, so quantity demanded will be greater than quantity supplied. That creates a shortage. Think of those impossible-to-get concert tickets at face value. High demand, limited supply at that price.
Okay, I get shortages. What about the opposite? Price too high.
If the price is set above equilibrium, suppliers are eager to sell high price.
Lots of supply.
But consumers look at that high price and think, maybe not.
Low demand.
Exactly. So quantity supplied will be greater than quantity demanded. That leads to a surplus. Imagine shelves piled high with unsold winter coats in the middle of July. Too much supply for the demand at that price.
So market equilibrium isn't some fixed target. It's constantly shifting based on all those demand and supply factors we talked about.
Precisely, it's dynamic.
What does it actually look like when one of those underlying curves moves? How does it affect the price and the amount sold?
Okay, let's connect this to the bigger picture. If there's an increase in demand, say, everyone suddenly wants electric scooters, so the demand curve shifts, right? What happens?
Oh, price goes up and more are sold.
Both. It pushes both the equilibrium price and the equilibrium quantity higher. More demand means higher prices and more transactions.
And a decrease in demand, less popular.
Does the opposite. Lower equilibrium price, lower equilibrium quantity. Now for supply, it's a bit different. An increase in supply, maybe that new technology makes scooters cheaper to produce, shifting supply, right?
Cheaper to make, so the price should fall.
Exactly. It leads to a lower equilibrium price, but a higher quantity sold. Think of a bumper crop of apples. Tons of apples flood the market, so prices drop, but more apples get sold overall.
And less supply. Maybe a key component becomes scarce.
A decrease in supply, leftward shift, means higher prices and lower quantities sold. Fewer available means they cost more.
What if both curves shift at the same time? Say demand goes up and the supply goes up.
Ah, now it gets trickier. When both demand and supply shifts, the effect on either price or quantity might be indeterminate.
Meaning you can't tell for sure.
Not without knowing how much each curve shifted. For example, if both demand and supply increase, you'll definitely sell more. The equilibrium quantity will increase, but the price, it could rise, fall, or stay the same depending on whether the demand shift was bigger than the supply shift or vice versa.
Wow, okay. That's a lot more complex than just supply and demand.
It is, but understanding those shifts is key.
Now, you mentioned markets finding their own equilibrium, but sometimes markets aren't left to their own devices, right?
Yeah.
Governments step in.
They do. Governments often intervene to try and set prices.
Why would they do that?
Usually with good intentions, like making essentials affordable or ensuring producers get a fair price. But it can lead to some really interesting and often unintended consequences.
Like what?
Well, a common tool is a price ceiling. This is a maximum price set by law, and crucially, it's set below the natural equilibrium price.
So artificially low. What happens then?
Shortages. Almost invariably. At that artificially low price, demand explodes. Everyone wants it cheap. But supply shrinks because producers aren't willing to sell for so little.
Can you give an example?
The classic one is rent-controlled apartments in some cities. The intention might be to make housing affordable,
What?
but it often leads to a severe shortage of available apartments, long waiting lists, maybe even landlords letting quality slip because they can't charge market rates. Demand exceeds supply.
That makes sense, that price ceilings cause shortages. But, for something like rent control, aren't there also arguments that it protects vulnerable populations, even with these economic downsides? How do policymakers weigh those competing goals?
That's an excellent point, and it really highlights the core tension. Policymakers often face this tough trade-off. Are they pursuing a social goal, like housing affordability or maybe worker protection, versus accepting the potential economic consequences, like shortages or maybe surpluses?
It's a balancing act.
It's a very complex balancing act, and economists often point out that while the intent behind something like a price ceiling might be noble, the unintended side effects can sometimes end up harming the very people it aims to help, perhaps by reducing the availability or even the quality of housing in the long run.
Okay, so ceilings cause shortages. What's the flip side?
The flip side is a price floor. This is a minimum price set by law, and this time it's set above the equilibrium price.
So artificially high, what does that cause?
Surpluses. At that high price, suppliers are eager to produce and sell, but consumers buy less. Quantity supplied exceeds quantity demanded.
What's a common example of a price floor?
The most debated one is probably the minimum wage. The goal is obviously to ensure workers earn a living wage.
Right.
But if the minimum wage is set significantly above the market equilibrium wage for certain jobs, businesses might respond by hiring fewer people at that higher rate. This can lead to a surplus of available labor unemployment, particularly affecting low-skilled workers who might have found jobs at a slightly lower wage.
So again, that tension between social goals and economic outcomes.
Exactly. It's a recurring theme when governments intervene directly in pricing.
Okay, so we've seen that prices and other factors cause changes in demand and supply and how markets balance or get thrown off balance.
Hmm.
Now, let's talk about how much they change. You mentioned sensitivity.
Yes, elasticity. It's basically a measure of responsiveness. Like stretching a rubber band, how much does quantity demanded or supplied stretch when the price changes?
Okay, elasticity. How do we measure that?
Let's start with the big one. Price elasticity of demand. How sensitive is the quantity demanded to a change in price? We measure it by dividing the percentage change in quantity demanded by the percentage change in price,
That's the formula, huh?
a simple ratio. And what's really crucial here is the absolute value of that number. We usually ignore the minus sign that often pops up because of the inverse relationship,
Why is the absolute value important?
because it tells us the degree of sensitivity. And understanding this, how sensitive your customers are to price changes, is like a secret weapon for businesses.
How so?
Well, if that absolute value is less than 1.0, we say demand is inelastic. Meaning quantity demanded doesn't budge much, even if the price changes significantly. Think about something essential, maybe like gasoline for many commuters, or critical medicine. You still need it, even if the price goes up a fair bit. Your demand is relatively inelastic.
Okay. And if the number's bigger than 1?
If the absolute value is greater than 1.0, demand is elastic. Here, a small percentage change in price leads to a big percentage change in quantity demanded. Consumers are very responsive.
Like what? Maybe switching soda brands if one gets expensive.
Exactly. Or maybe choosing a different restaurant if your usual place raises prices. Things with lots of alternatives tend to be elastic.
So is it just how essential a product is that determines its elasticity? Or are there other factors?
Oh, definitely other factors. Two big ones are the availability of substitutes. The more alternatives you have, the easier it is to switch if the price goes up, making demand more elastic.
Makes sense. More choices, more sensitivity to price.
Right. And the other big one is the time period. The longer the time period you're considering, the more elastic demand usually becomes.
Why that?
Because you have more time to find alternatives, maybe change your habits or adjust your budget. If gas prices shoot up overnight, you might still have to drive tomorrow, inelastic. But over a year, you might buy a more fuel-efficient car, move closer to work, or find public transport options more elastic.
That's fascinating. And you said this is a secret weapon for businesses. How does it affect their bottom line?
It directly impacts their total revenue, which is just price times quantity sold.
Sure.
Here's the key relationship. If your demand is elastic, sensitive, raising prices is a bad idea. Why? Because the drop in quantity sold will be proportionally bigger than the price increase, so your total revenue actually decreases.
Wow. So lower prices might actually make you more money if demand is elastic.
Correct. Lowering the price leads to a proportionally larger increase in quantity sold, boosting total revenue. But if your demand is inelastic, not sensitive,
You can raise prices.
you can raise prices, and the quantity sold won't drop by much, so your total revenue increases. This is huge for a pricing strategy. If demand is unit elastic, exactly 1.0, revenue stays the same whether you raise or lower prices.
That's a critical insight for any business owner. Okay, demand elasticity makes sense. Now, what about producers? How sensitive is their supply to price changes? That's price elasticity of supply, right?
Yep, same concept, just applied to supply. How much does the quantity supplied change when the price changes?
And what affects that? Is it just about wanting to make more profit?
Profit motive is there, but practicalities often dominate. For instance, the feasibility of storage. Products that can be easily produced and stored, like, say, canned goods or basic electronics, tend to have high supply elasticity. If prices rise, firms can just pull more from inventory or quickly ramp up production lines.
Easy to respond.
Right. But think about perishable goods, like fresh flowers or seasonal fruit. Supply elasticity is low because it's hard to quickly increase supply when prices rise. You can't just magically grow more roses overnight, and they don't last long in storage.
Makes sense. Anything else?
The time required to produce is also huge. If it takes years to build a new factory or grow a specific type of timber, supply won't be very elastic in the short term, no matter how high the price goes. It just takes time to adjust output.
Okay, so we have elasticity for demand and supply related to their own prices. What about how products affect each other? You mentioned substitutes and complements earlier.
Exactly. We can measure that too, using cross-elasticity of demand. This tells us how a change in the price of one good affects the quantity demanded of another good.
How does that work?
It's about the sign of the coefficient you calculate. If the cross-price elasticity coefficient is positive,
Meaning if the price of good Y goes up, demand for good X also goes up.
precisely, that tells you they are substitute goods. People are switching from the more expensive Y to X. Think Coke and Pepsi again.
Okay, and if it's negative?
If the coefficient is negative, they're complementary goods. If the price of product A goes up and demand for product B goes down, they're often used together.
Can you give us a quick, concrete example of that, like the steak and steak sauce you mentioned?
Perfect example. Imagine if the price of sirloin steak jumps, maybe from $6.50 to $7 a pound. And as a result, you see demand for steak sauce drop sharply, say from 60 bottles a week to only 38.
People aren't buying the expensive steaks, so they don't need the sauce.
Exactly. If you calculate the cross elasticity there, you'd get a strongly negative number, maybe around mega 4.77. That big negative sign clearly tells us they are complements. One affects the demand for the other because they're consumed together.
And if the number is close to zero?
Then they're simply unrelated goods. The price of pencils changing probably doesn't affect demand for cars much.
Got it. One more type of elasticity. What about our income?
Yes, income elasticity of demand. This measures how the quantity demanded of a good changes when consumer income changes.
How does this tell us about consumer behavior?
It tells us whether a good is, in economic terms, normal or inferior. If the income elasticity coefficient is positive.
So as my income goes up, I buy more of it.
Right. That indicates a normal good. Most things fall into this category. Think of a family whose income increases from, say, $100,000 to $120,000 a year.
Okay.
And maybe because of that, they start attending more sporting events, going from 5 games a year to 9. If you calculate that, you get a positive income elasticity, maybe around 4. It confirms that, for this family, sporting events are a normal good.
Makes sense. What if the number is negative?
If the coefficient is negative, that indicates an inferior good. This means as your income goes up, demand for that product actually goes down.
Wait, down. Why would you buy less if you have more money?
Because you switch to something better. Maybe as your income rises, you stop buying cheap instant noodles and start buying fresh pasta. Or you switch from riding the bus to buying a car. The instant noodles or the bus pass would be inferior goods in those cases.
Ah, okay, that makes sense. You trade up.
Exactly.
Let's pivot now. Let's talk about a huge economic force that touches every single one of us. Inflation.
Right. A big
Right.
one.
It feels like more than just prices going up, right? It feels like.
Mhm.
Like the value of money itself is changing.
That's a great way to put it. Inflation is that sustained increase in the general level of prices for goods and services over time. And crucially, as you said, it has an inverse relationship with purchasing power.
Meaning my dollar just doesn't go as far.
Exactly. Your money simply buys less over time. A slow, steady erosion.
So this raises an important question. How does this constant erosion of purchasing power impact, your investments, your debt, maybe a company's future plans?
It impacts almost everything. First, let's think about monetary versus non-monetary assets and liabilities.
That's the difference.
Monetary items are fixed in dollar amounts. Think cash, accounts receivable, notes payable, most bonds. Non-monetary items tend to fluctuate in value with inflation, things like buildings, land, machinery, inventory, common stock.
Okay, so how does inflation affect them differently?
During inflation, if you're holding a lot of monetary assets like cash or bonds that pay a fixed amount,
You're losing purchasing power.
you are. The dollars you hold or will receive are worth less in real terms. But if you hold monetary liabilities like long-term debt, say, a fixed-rate mortgage,
You benefit.
you actually benefit because you get to repay that debt later with dollars that are worth less cheaper inflated currency. Non-monetary assets, on the other hand, tend to hold their real value better because their prices can adjust upwards with inflation.
So inflation is kind of like this silent partner in your investment portfolio, for better or worse.
Absolutely. For debt investments, like bonds with fixed interest rates, inflation is generally bad news for the investor. It erodes the purchasing power of those fixed coupon payments you receive and the final principal amount you get back at maturity.
Even with floating rates,
Mm-hmm.
where the interest adjusts.
Even then, while the coupon payments might adjust somewhat with market rates, which often rise with inflation, the principal payment you get back at the end still loses real value due to the inflation that occurred over the bond's life.
What about stocks? Equity investments?
It's more complex for equities. Inflation can erode the real value of dividends if companies don't increase them. More directly, rising production costs for companies due to inflation, higher wages, materials, energy often lead them to raise their sales prices.
Which could hurt sales.
It could. If consumers cut back purchases due to higher prices, it can hurt the company's revenue, profit, and ultimately its stock price.
So is there any way to protect your investments from inflation?
Yes, there are ways to hedge. Certain alternative investments can offer protection. The most direct are probably Treasury inflation protected securities, or TPS.
How do those work?
Their principal value actually adjusts upward with the official inflation rate, like the CPI. So your investment's base value is protected, and the interest payments are calculated on that adjusted higher principal.
That sounds useful.
It is. For example, if company ABC invests, say, $4 million in TPS and inflation runs at 2.5% for the year, their investment principal literally grows to $4.1 million. And the interest they earn is based on that higher $4.1 million figure.
What else works as a hedge?
Other possibilities include real estate, whose value often rises with inflation, and commodities like precious metals, gold, silver, energy, and agriculture. These tend to move more in line with inflation than traditional stocks and bonds.
Okay, that's helpful for investors. Now, what about debt from the borrower's perspective? You said they benefit.
Yes, this is where it gets interesting for borrowers with fixed-rate debt. While rising interest rates generally make existing fixed-rate debt less attractive on the market, the inflation itself means the real cost of repaying that debt goes down over time.
Can you walk me through that?
Sure. Imagine company XYZ has a $1 million loan. It's a 10-year loan with a fixed 5% interest rate. Let's say inflation averages 2% per year over those 10 years.
Okay.
By the time company XYZ pays back that $1 million principal at maturity in 10 years, the actual purchasing power of those $1 million will have effectively shrunk due to that 2% annual inflation. It might only be worth, in today's terms, something like $820,000.
So they're paying back less in real value.
Exactly. The real burden of the debt has decreased thanks to inflation. It's a significant benefit to the borrower holding fixed-rate debt.
And for companies planning ahead, how does inflation affect their future expenses?
It pushes them up across the board. Production costs, labor, raw materials, energy, components, everything tends to get more expensive.
So they have to raise their prices just to stay afloat.
Pretty much. To maintain their profit margins, companies usually have to pass these increased costs onto consumers through higher sales prices. Think about labor costs. If a company's labor costs are, say, $28 million this year, and you assume just 2% annual inflation,
What will they be in 10 years?
they'll balloon to over $34 million just to pay the same workforce the equivalent real wage. That means the company's prices would also likely need to increase by at least that 2% annually just to cover those rising labor costs and maintain profitability.
Wow. Okay, let's shift gears a bit. We've talked about these broad market forces, supply, demand, equilibrium, inflation. How do individual businesses actually decide how to navigate all this? How do they come up with their game plan to succeed?
That's where strategic planning becomes absolutely essential, and a fundamental tool that many businesses use is SWOT analysis.
SWOT. What does that stand for?
Strengths, weaknesses, opportunities, and threats. Think of it as a company taking a hard look at itself and its environment. It's a crucial compass.
Okay, break that down for me. Strengths and weaknesses. Are those internal?
Exactly. The internal factors are the company's strengths and weaknesses. These are things the company generally controls. Strengths might be things like innovation, a really competent management team, unique skills or core competencies, strong leadership, maybe great marketing.
And weaknesses?
Weaknesses could be outdated technology, poor communication, lack of capital, unclear mission, things like that. It's about being honest about what you do well and where you fall short internally.
Got it. So S and W are internal. What about O and T? Opportunities and threats.
Those are the external factors, things happening outside the company that it doesn't directly control but needs to respond to. Opportunities might be a growing market, new technology emerging, favorable regulations, changing customer tastes that align with your product.
And threats.
Threats could be the opposite, a shrinking market, new competitors entering, unfavorable regulations, economic downturns, powerful suppliers or customers, the existence of substitute products. It's about scanning the horizon.
Can we make this concrete? Let's use the diverse company example from our notes. How would their SWOT look?
Absolutely. For a diverse company, their analysis might show strengths like strong international relationships. Maybe they're gaining market share, and they have improved operating margins from being more efficient.
Solid strengths. What about weaknesses?
Their big weakness seems to be outdated equipment. It's past its useful life, leading to high repair costs. That's an internal problem they need to fix.
Okay. Now externally, opportunities.
Big opportunities. There's increasing demand for personal healthcare products in emerging markets. That's a huge chance for them to expand globally.
Sounds promising. But there must be threats, too.
Definitely. The analysis identified threats like moderate barriers to entry in their market. That means new competitors could come in, so diverse company needs to keep investing in R&D to stay ahead. Also, they expect new compliance and regulatory costs, which could eat into those nice operating margins they achieved.
So the SWOT really paints a clear picture of their strategic landscape, where they're strong, where they're vulnerable, where the potential is, and what dangers lurk.
Exactly. It's a foundational piece of strategic planning.
Okay, SWOT gives the internal and external view.
hmm
Is there a way to look more deeply just at the competitive environment itself?
Yes, absolutely. Beyond SWOT, Michael Porter's Five Forces framework is an incredibly powerful tool for dissecting the competitive intensity within an industry, and therefore, figuring out its potential for long-term profitability. It helps companies understand where the real power lies in their industry.
5 forces. Okay, what's the first one?
The first force is barriers to entry. Basically, how easy or hard is it for a new company to just decide to start competing in this market?
Like how high is the wall to climb over?
Exactly. Barriers can be things like needing huge amounts of upfront capital, complex government regulations, strong customer loyalty to existing brands, needing massive economies of scale right away, patents, or even trade barriers.
So if barriers are high, existing companies are safer.
Generally, yes. Their profits are less threatened by newcomers. If barriers are low, profits are high, and the risk of retaliation from existing firms seems low, you can bet new companies will try to enter and grab a piece of the pie.
Okay, that makes sense. What's the second force?
The second is market competitiveness, or the intensity of rivalry among existing firms. This is often the most powerful force.
How fierce is the fight already going on?
Right. What makes competition more intense? Things like rivals being able to easily respond to each other's moves, lots of firms spending heavily on advertising or R&D, strong alliances between rivals and suppliers, a market that isn't growing much.
So everyone's fighting for the same customers.
Exactly. If the market isn't growing, the only way to gain profit is often to steal market share directly from a rival, which usually leads to brutal competition, price wars, ad battles, etc. High costs to exit the market can also trap firms and intensify the fight.
Okay, barriers to entry, intensity of rivalry. What's third?
The third force is the existence of substitute products. Are there other products or services out there, maybe from different industries even, that can do basically the same job for the customer?
Like taking the train instead of flying, or using a different software.
Perfect examples. If close substitutes are readily available, perform just as well, and are similarly priced, or cheaper, they put a strict limit on how much profit firms in the original industry can make. You can't raise prices too much, or customers will just switch to the substitute.
Especially if it's easy to switch.
Exactly. If customer switching costs are low, the threat from substitutes is much stronger.
Okay, 3 down. What's the fourth force?
The fourth is the bargaining power of the customers. How much leverage do the buyers have when negotiating with firms in the industry?
Can they push prices down? Demand better service?
Yes. Customer power increases when things like one customer group buys a huge volume of the firm's output, like a single big retailer. Buyers have lots of information about costs and alternatives. It's easy for buyers to switch suppliers, or there are simply many alternative suppliers for them to choose from. When buyers have power, they can squeeze industry profits.
Makes sense. And the fifth force must be the suppliers, right?
You got it.
Yeah.
The fifth force is the bargaining power of the suppliers. This is the flip side. Can the suppliers of inputs, raw materials, labor, components, services take profits away from the firms in the industry by increasing their costs?
When would suppliers have a lot of power?
Their power increases when, for instance, the firms in the industry can't easily switch suppliers, maybe because the supplier is unique or switching is costly, or if the supplier has an excellent reputation and high demand for their goods or services from other industries too. Powerful suppliers can dictate terms and capture more of the value chain's profits.
So understanding these 5 forces, barriers, rivalry, substitutes, buyer power, supplier power, helps a company see how attractive their industry is and where the threats and opportunities really lie within that competitive landscape.
Precisely. It's a crucial lens for strategy development.
Okay, so let's say a company has done its homework, they've done their SWOT, they've analyzed Porter's 5 forces, they understand their internal situation and the external competitive battlefield. Now what? They need an actual plan, right? A competitive strategy to gain an edge and build that all-important customer loyalty.
Exactly. They need to decide how they're going to compete.
What does a competitive advantage really mean in practical terms?
At its core, competitive advantage is about the value a firm offers to its customers minus the cost of actually creating that value. It's about delivering something customers want, either more effectively or more efficiently than rivals.
Okay. And are there basic ways to achieve that?
Broadly speaking, yes. There are two fundamental forms of competitive advantage. The first is cost leadership advantage.
Being the cheapest.
Essentially, yes. The firm aims to produce and sell its product or service for less than its rivals. This allows them to either undercut competitors' prices to build market share, or maybe match competitors' prices and just enjoy higher profit margins because their costs are lower.
Okay, cost leadership. What's the alternative?
The alternative is differentiation advantage, sometimes called an offering advantage. Here, the focus isn't primarily on cost, but on making the customer perceive the firm's product as superior or unique in some way that they value.
Like better quality, faster service, cooler design.
Any of those. Higher quality, faster delivery, superior customer service, innovative features, a wider range of goods, a strong brand image. Anything that makes the customer willing to pay a higher price for that perceived uniqueness or superiority.
So it's basically either beating rivals on price or standing out with something special that commands a premium. Let's look at the main competitive strategies companies actually use to achieve one or the other.
Sounds good. The first, building on cost advantage, is the pure cost leadership strategy. Organizations going this route aim to be the absolute lowest cost producer in their market.
Their whole focus is efficiency.
Pretty much. Their goal is often to use that cost advantage to undermine competitors' profitability, maybe drive them out and gain market share. Think about Toys Only Company, that online toy retailer example.
Right, they offer everything cheap online.
Exactly. They've mastered this by offering a huge line of toys at consistently the lowest prices. It's especially effective for products that are seen as commodities, where price is the main deciding factor for many buyers.
When does this strategy work best?
It works really well when buyers have strong bargaining power and low switching costs, meaning they can easily jump to a cheaper option, and when price competition in the industry is just brutal anyway.
And when does it fail?
It can fail spectacularly if the relentless cost-cutting goes too far and quality suffers dramatically, or if competitors find ways to lower their costs too, or simply if customers decide they're willing to pay a bit more for better quality or features and the low-cost leader ignores that.
Okay, so that's pure cost leadership. What about the other end? Focusing on being unique.
That's the differentiation strategy, or product differentiation. Here, firms work hard to create the perception that their product is better or truly unique in ways customers value, allowing them to charge higher prices.
Like the quality bathroom ink example.
Yeah.
The fancy tubs.
Perfect example. They sell high-end bathtubs and accessories with unique features, maybe special designs, premium materials. They're not competing on price, they're commanding premium prices in their regional market because customers see their products as superior and are willing to pay for that luxury or quality.
When does differentiation work well?
It works beautifully when customers genuinely perceive and value those unique aspects and, crucially, are willing to pay a premium for them. It also helps if it's difficult for competitors to imitate those unique features quickly.
And the downsides. When does it fail?
It can fail if firms misjudge what customers actually value. They differentiate on something nobody cares about. Or if the cost of creating that differentiation, extra R&D, marketing materials, exceeds the price premium customers are willing to pay. Or sometimes customers might just decide they prefer cheaper, more generic products after all, regardless of the fancy features.
Interesting. What if a company tries to do a bit of both? Offer something good, but not at a rock bottom price, nor at a super premium one.
That's becoming increasingly common. It's called a best cost strategy. This approach tries to blend elements of both cost leadership and differentiation. The goal is to offer customers higher value for a reasonable price.
So not the absolute cheapest, but good quality for the money.
Exactly. Think a high-quality product at a good, competitive price. Walmart Inc., the mass merchandiser, is often cited as a master of this. Through their incredible economies of scale, they offer very low prices on a vast range of products, including both well-known brands and their own decent quality generic lines. They provide what many see as superior products compared to dollar stores, but at overall low prices compared to department stores.
When does this best cost approach work well?
It tends to excel when buyers are sensitive to price but find purely generic, low-quality products unacceptable. They want value, which includes both price and quality features.
Where can it go wrong?
The big risk is getting stuck in the middle. You might fail to appeal strongly enough to customers who really want the lowest possible price and fail to appeal to those who want truly differentiated premium products. You end up not being the best at anything.
Okay, that makes sense. One more type. What are companies that don't try to appeal to everyone but focus on a specific group?
Right, those are focus niche strategies. Here, firms apply either cost leadership or differentiation, but they do it within a select small group of consumers or a very specific niche market that has specialized needs and preferences.
So they're targeting a narrow segment.
Exactly. Instead of competing industry-wide, they focus intensely on serving just that niche. Take the All-Star Baseball Gloves Inc. example.
They make gloves just for serious players.
Right. They don't make cheap gloves for kids' leagues. They craft premium baseball gloves using top-tier leather and special features, specifically targeting the collegiate and professional niche market. They might use differentiation within that niche, or another niche player might use cost leadership within their narrow segment.
When does this focus strategy work well?
It works well when the niche market is large enough to be profitable, has good growth potential, and maybe isn't crucial to the success of major, broad competitors. It also helps if the focuser has unique skills to serve that niche effectively.
And the risks.
The risks are that large competitors might identify the profitable niche and decide to enter it with their greater resources. Or the needs of the niche customers might gradually shift towards the broader market's preferences, eroding the basis for the focus strategy. And of course, the firm has to be truly responsive to the very specific needs of its niche customers.
Wow. We've really covered a lot of ground today.
Yeah.
From the basic give and take of supply and demand, all the way to these intricate strategic decisions businesses have to make every single day.
It really is a dynamic and complex economic ecosystem, isn't it?
It truly is.
And remember, these concepts we've discussed, elasticity, equilibrium, inflation, strategy, they aren't just abstract theories you read about. They are the real driving forces behind the products you see, the prices you pay every day,
Yeah.
and the big decisions companies make that directly impact your life, your job, and the broader economy.
Our mission today was really to give you a clear, comprehensive, and hopefully engaging shortcut to being well-informed about these market influences.
Yeah.
We hope you feel, much more confident in understanding the economic world buzzing around you.
Yeah, hopefully spotting some of those invisible forces at play now.
Definitely.
And maybe this raises an important question for you to think about. As you observe the market around you this week, consider this. If a brand new technology suddenly comes along and dramatically reduces the cost of producing some popular item,
Okay.
how might that ripple effect play out? How might it impact not just the item's supply and its price, but maybe also the competitive strategies of other firms in that industry?
Hmm.
And what about the bargaining power of you, the customers who buy it? How might that shift?
That's a great thought experiment. Lots of interconnected effects.
Indeed.
Well, thank you so much for joining us on this deep dive into the fascinating world of market influences. Keep asking those curious questions about the economy around you,
Absolutely.
and we'll be here to help you unpack them